Hi, everyone. This is Demo Gonzalez of Heartwood Financial Services. Thank you so much for joining me for another monthly market update. I hope you guys don't mind my little gimmicky background here. I have what is a tunnel and with light at the end of it. So you're starting to see my quirky humor here. So it's been quite a 12-month period. 12 months ago, we were in the middle of full lockdowns. Everybody was very anxious about what was going on with the virus and our health, and of course, the economy. And fast forward 12 months, we have made a lot of progress on the virus. The stock market has recaptured where it was, and it's now at new highs. The economy is starting to look pretty strong, and so it's pretty amazing. I hope everybody's doing well. I hope you guys enjoy the video. We're going to talk about how we're not completely out of the woods yet. Oops, I gave it away, the answer. I shouldn't have done that. But I hope you guys enjoy the video. And as a reminder, there is a shorter version if you just go to the slides where you have my picture at the end, or you can stay on for the extended version where we get into a little bit more of the details. It's a little longer, but thank you for watching. And if you have any questions or concerns, please reach out to me. Thanks. Hi everyone, as always we like to start with the asset class returns, and I'm happy to report some really great numbers for the month, but also pretty phenomenal numbers for the year. If you can remember, the pandemic started right around a year ago, so the 1 year numbers are going to look really fantastic. So let's start off with the large cap. Large cap stocks are up 4.38% for the month, so another pretty strong month. Fizzled out a little bit at the end of the month, but it really started strong. And for the year, for a 1 year period, you can see it's up 56%. Pretty phenomenal. Again, this is the S&P 500. Some people are starting to say the stock market's starting to get a little expensive. I would agree with that. It is starting to get a little bit expensive. Luckily, interest rates are still pretty low, and that helps. But at some point, even with low interest rates, the market starts to get a little expensive. And we'll talk more about, the prospects going forward and what's keeping the market going up. The next piece is small cap stocks. For the month was up 3.33%. So small caps have actually been really leading the charge for the last 6 months or so. It fizzled out a little bit more at the end than even the large cap, but still had a 3.3% gain for the month of March and a whopping 95% for the year. Pretty amazing. Real estate was actually one of the best performing asset classes, up 6.81 for the month of March and up 32% for the year. So a lot of that has to do with the fact that the economy is starting to reopen, and a lot of these stocks really got beat up and really hadn't started coming back until recently. You can see the 1 year number reflects that. And then we have developed international. That was up 2.34% for the month. So still pretty good, not as strong as the U.S. stocks, and still pretty strong also for the year at 51.5. So that's been good. They've been lagging a little bit with the vaccine. I'll talk a little bit more about that. That's hurt their comeback, and they're reopening a little bit. Emerging markets down 1.55%, but still very strong for the 1 year at 57.5. It doesn't look like things with China are going as smooth as everybody hoped. There's still some thorny relations, let's say, with China, and China is really the biggest piece of that emerging market area. And also you have Brazil and a lot of other emerging market countries that are really still struggling with COVID and haven't really seen that reopening uptick like we've seen here in the United States. Fixed income minus 1.1% for the month and only 1.29% for the whole 12-month period. That's pretty amazing. You would thought that that would have been a little bit better with as bad as things were last year, but again, things started turning right around in April of last year. And in fact, I don't have the quarter number but for the quarter, Treasuries have had one of the worst performances on record because interest rates have been coming up. Then we have high yield. High yield was down 0.84%, but nicely up for the 1 year at 21.52. That's one of the few bright spots in the bond market, as well as floating rate bonds, which I don't have here, but they're kind of related. And then the last one is gold. I could do a whole video on gold, but it's down again, down 2.97, up 5.1 for the year, but down again for the month. So it's been a pretty lousy quarter, really a pretty lousy almost 6 months now for gold. And that's what we're seeing, is that the dollar has actually been pretty steady. It hasn't really taken a big hit like a lot of people thought with all the stimulus and all the monetary policy easing. It hasn't really hurt the dollar too much, and some of that's because everybody else is doing the same thing. And we're also seeing the U.S. economy really coming back pretty strong. So that's been helping the dollar. And gold really is not so much an inflation hedge, but a dollar hedge. And so with the dollar being steady and actually going up a little bit here in March, we're seeing gold continue to struggle there. And we'll talk about a couple other ideas I have on that front for inflation. Thanks a lot. So the market update slide is, are we out of the woods yet? And the fact that we're even asking the question shows how much progress we've made. And things have improved quite a bit. So I'm going to give you some updates and give you some thoughts on how things have gone and hopefully where they're going. So to start off with is the COVID update. I would say that we are not quite out of the woods yet, because with COVID it seems like the cases have been going down dramatically over the quarter, which has been really, really good to see. But it seems like it started to plateau here over the last few weeks, and the deaths as well. So as encouraging as we've seen the progress, we still have a little bit more work to do. Now on the good side though, what we're seeing is we're getting very close to herd immunity. And so I got a little bit more on that on the extended version. And as we get closer to that, we get closer to really opening things up for good. So that'll be very, very encouraging. And then the other interesting thing about COVID is that we're also we're showing that we're doing really good versus Europe and some of the emerging countries, which is why you've seen our economy really open up sooner, and we've seen our market really rally a little bit more than some of the international stocks. And I think it has a lot to do with COVID. Inflation so far in check, but expected to rise. The inflation number came out for March and it was 1.4%, which doesn't seem too bad. It was actually the same as January, but that could be changing. I mean, we've had a lot of stimulus that has come out, and now we're even talking about another one with an infrastructure plan, and so we'll see if that goes. But it likely will. I mean, with the Democratic control of the White House and Congress, it has a good chance to pass in some form. And so the pent-up demand, the stimulus, the monetary easing, all these things are going to probably make inflation go up. And the fact that inflation was super low last year, and when you compare it to last year, it's going to be easy for those inflation numbers to go up. They call it the base effects. So it's likely to happen. So we'll definitely talk about how to address that in the portfolio in the outlook section. And the leading indicators have been very strong. I mean, almost off the charts. The number for last week came out for employment, and it was almost 1 million new jobs for the month of March. Pretty phenomenal. And then the one I'm going to highlight in the extended version is the ISM reports. There's two of them, one for manufacturing and for services. And these are one of the most important leading indicators out there, and they're looking phenomenal. So I'll talk a little bit more about that one next. And then, of course, to finish up the GDP numbers, the projections for 2021 are great. We're normally at around 2.5%. We're talking 5.5 to up to 8% in GDP growth for 2021 and potentially beyond. Not at that level, but still very high going out for 2022 and even potentially further. And so this is very encouraging for the stock market. This, again, is what the stocks have been, or for the economy, and this is what stocks have been pointing out over the last year. So we're finally starting to see it into fruition, which is good news. Okay, for the outlook slide of the month, I have it titled, is 2021 going to be a sugar high? Well, that's a good question. I don't know if I have the exact answer to that. And so we'll start off with the question, will it be a sugar high? I think it's going to be a great year. And it's going to be probably the best year we're going to see in a while. Now, the CBO has some numbers, and I'll get more into it with the extended version, that show the economy could be above average for the next several years as well. And a very famous CEO, Jamie Dimon, had this very extensive letter that he had out this week that shows that he thinks it could go out till 2025. So he's very encouraged by what he's seeing. I'm hopeful, but I'm also a little skeptical. So that's something that we're going to be watching very carefully. The next piece for the outlook is our taxes going up. And how will that affect stocks? I've had this question come up a lot, and I've thought about this a lot. And our taxes going up, that's up in the air. Right now, it does look like they probably will. Corporate tax rates right now are being tied to the infrastructure plan, which in some form or fashion does look like it's going to be a go. And there's going to have to be a pay for. And of course, corporations are usually the low end of the totem pole to go for, to pay for things. And so that's likely to happen. How bad is it going to be? Is it going to go from the 21 all the way back up to 28 like in the proposal? I don't think so. It'll probably go up, but just maybe somewhere in the middle. And then as far as individual taxes, the word is that taxes shouldn't be going up for people making less than $400,000. And so that will probably be the direct effects of maybe what comes down the pike. But as we all know, when taxes go up, and especially for corporations, they do tend to have those extra costs roll down to the end consumer. So we'll have to see. And will it hurt the stock market? I think it will, but it may not be as bad as some people are projecting. I have some numbers in the extended version that I'll get more into that with you. Okay? And then the other piece that we've been talking about has been inflation. And I'm becoming more and more concerned about that. I don't think it's going to be as bad as some of you that I've talked to, but probably not as benign as the Fed has been making it out to be. And so I've definitely been adding some inflation hedges in the portfolios. And one in particular that I've been adding for the last month or so is adding a little bit more to the commodity side of things. And I'll get more into that in the extended version. Gold, commodities, stocks, emerging markets, all those different things do pretty well to fight inflation. The downside with commodities, though, is they tend to not pay much of a dividend or any kind of interest or anything like that. So I have an idea that I think has been working pretty well in going into energy companies that either transport or drill or are involved in some sort of the exploration of energy. And as we all know, energy is starting to get faded out with the oil, that is. But it's probably not going to go away anytime soon, especially as the economy is really coming back very, very strong, and with inflation starting to peek its ugly head up. And lastly, we got the positioning for the portfolios here for this year, I still think we have a very strong 2021. So I'm going to continue with favoring the reopening stocks, those cyclical stocks. They tend to be more value, small companies, also international companies, and keeping a slightly lower exposure to bonds because rates will probably continue to go up. They've been steadying a little bit, which has been good, but they're steady, but they're still creeping up a little bit, and that's probably going to be the trend through the next couple of years. So lowering the exposure there as well. So thanks a lot. Now for the educational slide of the month, we have a very interesting question. Can the market crash during an economic boom? We've had, like I said, quite a comeback. The economy is starting to really boom. And some people are afraid that maybe the stock market got a little too ahead of itself. It's a little too high, and we could actually maybe see a crash during the boom. So we did a little history, or we looked back at a little history. I found this great article by Ben Carlson who talked about this, and he has this chart here that shows how the GDP, when it's at these different ranges, what the actual S&P 500 returns have been during that year. And as you could see, when the GDP numbers are above 4%, the stock market has been very, very strong. And as we talked about a moment ago, GDP numbers are expected to be well above 4%. How much we'll see. But what's interesting is that the averages sometimes hide some one-offs. And so it has happened before. So in 1938, the stock market was down when we had 5% GDP growth. Now that was a little bit of an odd thing. We actually were heading into a recession towards the end of that year. And really nobody can imagine us going into a recession by the end of this particular year, right at the beginning of a big boom. The other time when there was a negative return was in 1941. Now, we actually had double-digit GDP growth, but the stock market ended up down. So what happened there? Well, it was the beginning, or at least the fears that were starting to show up from World War II. Okay, and so not sure if there's any world wars in the horizon. I hope not. I know that we've been butting heads with China a little bit, but I don't think it's gotten to that magnitude yet. So again, the fact that the market or the GDP numbers are going to be so good this year show very good sign that we'll probably continue to do pretty well with the stock market. Maybe not as good as average as we see here because we've already made up so much ground, but a positive return it looks very likely based on this historical context. And I always like to end with an inspirational note. This one is maybe an inspirational / public service announcement. But I wanted you guys to know that 73% of Americans rank their finances as the number one stress in life. And this is according to a study done by Capital One CreditWise survey. And there's been a lot of surveys like this, so this is not a one-off. There's a lot of people out there that worry about their finances. And so my advice to those people is really a simple two-step process. First of all, you need to make a plan, okay? What's worrying you is the unknown, and you need to tackle that unknown by putting together a plan. Now, a lot of people can do this themselves, write down a budget, start thinking about some goals, assigning some numbers to them, but a lot of times people need help with that. And so that's why there's financial coaches, advisors, financial planners. That's something that I do a lot with my clients as well. So I would encourage you to first step is to get together either with your spouse or whoever you're working with or an advisor to help you put together a plan. The second part, almost equally as important, it's the let go part. And this is where You just have to have a little faith. You've done everything that you can. You've planned. And sometimes you just have to have a little bit of faith that God's going to take care of you. And so I wanted to finish off with a verse from Matthew. This is one of my favorites. That God is the giver of good gifts is the title of it. And it goes like this. Which of you, if your son asks for bread, will give him a stone? Or if he asks for a fish, will give you a snake? If you then, though you are evil, know how to give good gifts to your children, how much more will your Father in heaven give good gifts to those who ask him? So I think that makes a really good point. Even we do good things to our kids. Our Father in heaven would definitely take care of us because he's good. And he's got a lot of resources. So thanks again, guys, and we'll see you next month. Okay, thank you for sticking around for the extended version. You guys are the hardcore, the guys and gals that really like to get into the nitty-gritty. And so I'll share some more detail about those two slides that I had for the update and the outlook. And in the update, we talked about how we're not quite out of the woods yet with COVID. You could see the numbers here have gone down quite a bit, but they've been starting to level off. And so I've been a little bit concerned about that. And so I'm optimistic, but also, kind of cautious in looking at that. But the very good part here is you could see the numbers vaccinated are in the green, the estimated people that have been infected, and the estimated infection and vaccine. So you can see how we're really getting pretty close to that in, zone of herd immunity when things can really start opening up because the cases start to dramatically drop. So we're getting really close. The fear is that maybe there's some variants and things that could throw things off. So the more we get vaccinated, the quicker we can get to that herd immunity, and we seem to be well on our way for that. And on the update slide, we talked about inflation as well and how things are kind of in check for now, but how they could get a little bit worse. This is a slide that shows what the recent stimulus plan is going to do to the what they call the output gap. That's the gap between what we could, our potential to be able to do as an economy, and what we were under or over. And so we had a pretty good gap, 2021 output gap, as you can see right here, with and depending on the multiplier, and this gets a little wonky, of how much it actually improves the economy. So if it's dollar for dollar, because it was 1.9 trillion, if it's dollar for dollar, we would way overshoot the output gap. So the point that I'm making with this chart is that this 1.9 trillion is going to probably be inflationary because it's well above the gap that there was in the economy before the stimulus. And if it has an even bigger multiplier effect, it could have an even grander effect to the economy. Now the Brookings, their estimate is somewhere about at 1.5 trillion. So that whole 1.9 isn't necessarily going to go directly to boost that output gap. But even if it's the 1.5, that's still what you can see here, 200% of the 3-year output gap. And so if we're at that high of a level, you could see how that can possibly start to cause some inflation that could come down the pike. And in the update, you also saw me talking about how the leading indicators have been looking really, really strong. And this is the ISM manufacturing. It's actually the highest it's been in 38 years. We're almost at a 65. Now anything above 50 is expansionary. So we're well above that. You can see how we dropped below that during the pandemic bottoms, but we have come back dramatically from that. And this is one of the strongest leading indicators out there. And so some are saying maybe it's about as high as it can go, but you could see the trajectory is still pretty much straight up. So we could see a few more really strong prints in this leading indicator, which is very, very strong. And even if it starts to go down, it's still expansionary. It just needs to go below 50 for it to start to show that things are contracting. And that could be a while from this chart. So in the outlook, I mentioned the sugar high question. This is a chart from the CBO and their projections of real GDP growth versus what would normally be our potential GDP growth, which is that lighter colored line. So this darker one is the projected one. And so you can see how it spikes here in 2021, and then it starts to taper down, but it's still higher than its potential going out past 2025. That's pretty optimistic, and I hope they're right. And there's some people that agree with this, and that remains to be seen. Something that we'll definitely be keeping a close eye on. But it could be something that lasts for more than just this 1 year. Now, in the outlook slide, we talk about how taxes are probably going up for corporations and for some individuals potentially. This is a chart that shows if the Biden plan goes in full effect, where they bring the statutory rate from 21 to 28%, and also, which is in the plans, is to raise the tax that's received from companies overseas to a certain minimum. And so that's from 11 to 21. And so if those two things happen, the effects on earnings is significant. You can see on average it's somewhere around 8% decrease in earnings. But you can see how it affects some sectors more than others. Tech being one of the big ones. They get a lot of their revenue from overseas. So that could affect them quite a bit. But overall, you can see it will have a significant impact. The market hasn't really priced this in yet because they see as this is probably not a super high likelihood of it being this dramatic. And so, of course, we're all watching and waiting to see what happens. I will be. And for the last slide, one of the ideas I had for for an inflation hedge. This is the same slide from last month. We're in this low inflation but rising inflation quadrant, and you can see gold and commodities and REITs, emerging markets, and stocks in general do pretty well in this environment. Commodities, I haven't had too much exposure in that area, and so I've been starting to add on my more moderately aggressive to aggressive growth portfolio has been adding to some master limited partnerships, which are energy companies mostly involved in transportation. But what's nice about them is they have that commodity exposure, and you also get a nice dividend from these types of stocks. Now, unfortunately, they are very volatile, so I've only been adding them to the more aggressive, moderately aggressive clients for now, and in very small increments. But that's just another little layer to all the other layers that we have in there to hopefully help us fight inflation.